The government says inflation is fixed, 2%. The grocery bill disagrees. Food prices up 2.8%. And that gap isn't a mistake. I'm David. This is how corporations engineered the price you pay and why central banks may never reverse it. Here's where. The official inflation number in January 2026, 2%. But walk into any grocery store and the story shifts. Food prices sit at 2.8% year over year. That gap, that small, persistent gap between what government measures and what families actually buy, is where this story begins. Across the United States, shoppers report identical sticker shock. Milk costs more than a year ago. Meat costs more. Eggs, bread, cheese items you can't substitute, can't skip, can't wait out. The Federal Reserve claims victory. The typical household gets a different message every single time they check out. The paradox is specific and real. Inflation officially conquered, yet food inflation stubbornly outpacing the broader measure. For someone buying groceries every week, that differential compounds week after week. It's not massive in quarterly economic reports, but it's accumulated weight, the kind that shapes whether your next paycheck feels like enough. So why? Why does the official number say inflation is solved while your shopping cart tells a completely different story? That answer is buried in how companies chose to survive the crisis and what they decided to never give back. Understanding that requires a detour into market mechanics. When costs spike, businesses raise prices instantly. When costs ease, prices stay put. Economists call this asymmetry menu costs. The friction and risk of changing price tags, retraining staff, updating systems, cannibalizing customer loyalty. But there's a deeper layer. Consumers anchor to the last price they paid. A can of beans priced at $2.50 becomes the reference point, the expectation. When inflation spikes and beans jump to $3, shoppers feel the sting immediately, but that new price becomes the anchor. When commodity costs ease 6 months later, managers face a question. Do we risk shocking the customer by dropping to $2.90? Or do we keep the higher margin and call it a new equilibrium? Most choose the second path. The price doesn't fall because falling it feels like leaving money on the table, and because the anchored customer, once shocked upward, rarely punishes a company for holding the line. What takes months to justify as an emergency becomes years of protected margin once the emergency fades. This is not malice, it's a rational response to asymmetric risk, but it means the prices that spiked in a crisis become permanent features of the economy. And that's exactly what happened after 2021. When inflation hit in 2022, that rational calculus shifted everything. Commodity prices exploded, fuel costs soared. Food and drink manufacturers, Nestlé, Danone, Unilever, Coca-Cola, faced a choice: absorb the losses or pass them to consumers. Absorbing would have crushed their margins. So they raised prices, sharply. Here's the part that haunts the current inflation story. By 2024, these companies didn't just recover their margins, they exceeded them. Nestlé's profitability, Unilever's returns, Danone's bottom line, all stretched beyond pre-crisis levels. The price increases they justified as emergency measures became permanent. The mechanism is crucial. When costs spike, raising prices works. Customers accept it as necessary, almost apologetically. But once costs ease and commodity prices by early 2026 had retreated significantly, the psychological permission to hold prices expires. Companies hold them anyway, not through price fixing or conspiracy, but through the collective logic of anchoring and loss aversion. Food companies had engineered a wealth transfer from household budgets to shareholder returns. And unlike temporary spikes, which feel transient, permanent price levels feel like the new normal. By the time customers realized the crisis had passed, the higher price had already become the baseline expectation. But the story gets worse, because not all price increases came from margin protection. The supply chain itself changed. After 2021, companies couldn't rely on just-in-time inventory fed by low-cost shipping through choke points like the Port of Long Beach. Shippers were jammed. Container costs quadrupled, so retailers nearshored inventory, built buffer stock closer to home, paid more for domestic logistics, absorbed higher warehousing costs. These were one-time shocks. Once incurred, they should have eased. Shipping eventually untangled. Container rates dropped. Warehousing excess should have been liquidated, but the costs calcified into permanently higher retail prices. The logic mirrors the margin story, but it's subtly different. A company that nearshored inventory and raised prices to cover that cost doesn't want to reverse engineer the entire supply chain back to just-in-time, even if costs ease. The infrastructure is built, the contracts are signed, the new distribution network is optimized. Undoing it would mean disruption, retraining, and risk of stockouts, so the higher prices originally justified by extraordinary logistics costs persist as structural costs. A port bottleneck in 2021 triggered a pricing decision that, 5 years later, still echoes in what you pay for groceries. The crisis created the infrastructure. The infrastructure now justifies the price. But here's the twist. Not all prices stuck equally. Watch the gap widen between energy and food prices. Energy fell to ATW14% year over year. Food climbed to plus 2%. What separates them? Commodities that trade globally eased as supply normalized, but food and services trapped in domestic supply chains couldn't follow because they rely on local labor and facilities. That selective stickiness reveals the dividing line between prices that finally fell and ones that stayed locked in place. The official inflation number also masks the pain because of how it counts. The Consumer Price Index uses two tricks that make inflation look lower than it feels. The first is hedonic adjustment, counting quality improvements as deflation. Suppose a new phone costs the same as last year's model, but has a better camera. The CPI counts that as a price cut, even though you paid the same amount. Applied across thousands of goods, hedonic adjustment shaves points off the inflation rate. The second is substitution bias. If beef prices spike, the CPI assumes you switch to chicken. The index measures the cheaper basket you supposedly chose. But if you have a family to feed, you don't always have the luxury of substituting away from the items you need. You buy the expensive beef, or you don't feed them well. The CPI assumes flexibility that many households don't have. These adjustments aren't lies. They're designed to measure living standards, not just nominal price movements. But for a household locked into essentials, food, housing, transportation, substitution, and hedonic adjustment feel like accounting tricks that erase real experience. The official inflation number says inflation was conquered. The mechanism of that conquest is partly statistical. So who actually benefits from prices staying elevated? That question has a bitter history. Countries have tried different approaches, and the results split cleanly. Argentina used wage price agreements and price monitoring. It failed. Venezuela tried price controls. Hyperinflation followed. Belarus suppressed prices artificially. The suppression proved unsustainable. What worked was the opposite. Credible monetary tightening without intervention. Brazil raised rates aggressively, and the central bank's credibility anchored inflation expectations. Peru built confidence in its inflation targeting framework. When people believe the central bank will hold the line, they don't panic. Buy and bid prices up. Chile saw peso appreciation and easing commodity prices, but it was tight monetary policy that created the space for prices to actually fall. The lesson is sharp. Price controls, or heterodox measures, don't reverse stickiness. They create black markets, supply collapses, and eventually deeper inflation. What works is central bank independence, the boring, credible promise that you will tighten policy enough to create economic slack, and you'll tolerate that slack long enough for prices to normalize. But that requires tolerance for temporary unemployment and slower growth. It means accepting short-term pain for long-term stability. Not every government can afford that politically, and here's where the global story fractures. Which brings us to the countries that couldn't afford that choice. Emerging markets face a structural squeeze. When the US dollar strengthens, and it did in 2022-2024, imported goods become more expensive. India, Brazil, Southeast Asia, Africa, when you import food, fuel, machinery priced in dollars, a strong dollar translates directly into higher import inflation. But here's the trap. Developed economies like the US have supply chains that buffer domestic prices. They manufacture locally, source diversely, negotiate contracts. When import costs rise, they're distributed across complex networks. Emerging economies often lack that buffer. A price shock from imports hits smaller retailers and manufacturers directly, with fewer options to absorb it. So while food prices in the US stayed sticky because of company margins and supply chain restructuring, food prices in India climbed because imported inputs cost more, and local manufacturers had no choice but to pass that directly to consumers who could least afford it. The strong dollar encoded a global wealth transfer from emerging market households to dollar-denominated asset holders, mostly in the developed world. This wasn't an accident. It was the global economic structure working as designed. The question now is whether this price plateau persists. Price normalization isn't automatic. It requires something almost nobody wants to grant central banks: the independence to tighten policy enough to create genuine economic slack, and the political tolerance to hold that slack in place for months or years. Brazil had it. Peru had it. The US, under Jerome Powell, showed hints of it in 2023-2024. But maintaining that independence is hard. Governments face election cycles, pressure from voters, and the visible pain of unemployment. The temptation to relent, to cut rates early, to print money, to offer fiscal relief is constant. And the moment a central bank shows it might relent, inflation expectations unanchor. Prices spike again. So here's the uncomfortable truth. The prices you pay for food in June 2026 aren't random. They're the product of corporate decisions to hold margins, supply chain restructuring that calcified into permanent costs, global currency dynamics that favored some economies over others, and a central banking choice to either maintain independence or cave to political pressure. The plateau persists because the people with the power to reverse it, central banks, governments, have chosen conditions where reversal is harder than accepting the elevated baseline. Inflation wasn't conquered, it was engineered into a different shape. Inflation wasn't beaten, it was restructured, and reversing it is now harder than accepting the plateau. Subscribe for more on how systems engineer prices. I'm David. See you tomorrow.